Hello again, traders. Doing job there from DRFX, Swing Trading Mentoring. Gonna be taking a look at the recent trade that was made on the Euro Japanese yen last week, which provided me with a trading gain of 100 pips to basically show you the process that we need to use to accurately identify what is taking place in the currency market, to be able to consistently take advantage of it and capture consistent trading gains every week. Now, identifying market direction is the most important thing to do when it comes to trading the currency market. But a lot of us fall short in terms of being able to predict exactly what is taking place in the currency market. And this is what leads to a lot of confusion and stress and uncertainty that prevents us from achieving consistent rates of returns. So I believe that following certain steps and guidelines in terms of identify what is taking place in the currency market will help to solve these issues and to put us on a path towards consistent trading success. Now, the first two things that I do in my trading that I recommend that everybody does is to first of all identify whether or not the market is trending or whether or not it's in a consolidation setup. Now, what I found over the years is that the market will either be breaking out of a consolidation, forming a consolidation and moving within the boundaries of consolidation, or is actually in a trending direction, either in a downtrend or in a strong uptrend. So identifying what is taking place, the market pattern that the market is showing at any particular point in time, are the first two steps in terms of determining what is taking place in the currency market. So in the case of the Euro Japanese yen that was traded last week, this was a setup on the daily chart, and what you'll find was that the market was actually in the process of forming a range consolidation setup on the daily chart. As you can see here, the support boundary was already formed, and what was now taking place was that the market was forming the resistance boundary by creating the second resistance point by this bearish U-turn that would take us down toward the support boundary and complete the formation of this range setup. So on the daily chart, the market was in the process of forming a consolidation setup. Now on the 4-hour chart, what was taking place was that the U-turn that we just saw taking place on the daily chart was actually created by this breakout that was taking place on the 4-hour chart. So specifically what was taking place was that the market had formed this range setup and had actually attempted to start a bullish breakout. But instead of continuing the movement bullish, the market U-turned aggressively bearish to start the breakout at the other end. And in so doing, it also created this downtrend. So the market was breaking out of a consolidation as part of a false breakout reversal and was also forming this downtrend on the 4-hour chart. Now the next step is to identify where the market is headed and of course to identify false breakouts. Because what can take place is that we can see the market providing us with signals that tell us that it's going in one particular direction. But if those signals are actually weak or the overall setup does not support the market moving in that direction, then there's a greater chance that the market will reverse and take out our trading position. So here's an example of how consolidations are formed. What you'll find is that when the market is moving within consolidation, it will simply move from resistance to support and back until the breakout finally takes place. So your trading targets whenever the market is moving within consolidation is to trade to these boundaries and exit at those areas just before the market starts to U-turn and head in the opposite direction. Now in terms of false breakouts, these are situations in which the market will attempt a breakout at one end of the consolidation and then U-turn aggressively to head back inside of the consolidation and break out at the other end. Now there are ways in which you can anticipate that this signal is going to be a false signal if the overall setup of the currency market or of the time frames that we're looking at gives this breakout direction a low probability of actually working out. So in the case of the Euro Japanese Yen daily chart, because the overall setup was that the market was going to be forming this consolidation setup and was going to be headed to this support target, what it meant was that the attempted breakout of the 4-hour chart range at the resistance had a very low chance of actually working out. So it was no surprise that the market reversed sharply and headed back inside of the consolidation to break out at the other end, because this was in keeping with what was taking place on the daily chart, where the market was forming this consolidation and headed towards this support target. Now, in terms of choosing our trading targets, once we have identified where the market is headed, and choosing our stop loss areas to protect our trade when we have identified an entry signal to trade in the direction of the market. Now, as I said before, whenever the market is moving within consolidation, we simply trade between resistance and support. And so in this particular case with the Euro Japanese Yen, the major trading target is going to be support. But depending on your trading strategy, you can choose to capture any number of pips along the way until the market eventually hits the support target. So you do not necessarily have to trade and set your target to the support. You can set a trading target of 10 pips, 50 pips, 100 pips, or 200 pips. As long as it's in the direction of where the market is headed, and as long as it is not beyond where the market is going to be headed, in this case the support boundary. Now, in terms of your stop loss placement, the best areas to protect your trade when it comes to trading, whether you're talking about an uptrend or downtrend, is at the trend line or the counter trend line. In the case of the counter trend lines, these are setups where the market will temporarily pull back against the main direction of the trend, main trend direction, and then U-turn to continue in the direction of the trend. So what can be done is that you can place your stop loss above the high of the U-turn in the case of a downtrend and the low of the U-turn in the case of an uptrend. And of course, what you can also do is that in the case of a downtrend, you can place your stop loss above the high of the counter trend line U-turn as well as above the downtrend line itself. So those two areas combined can provide you with a strong stop loss area to protect your trade until the trading target is hit. So in the case of this trade on the Euro Japanese Yen, my entry took place on the 4-hour chart, and I placed my stop loss above both the downtrend line and above the counter trend line itself. So entry took place as soon as the market broke below the counter trend line, with the target set for 100 pips at this price limit here. So what you'll notice is that this was a bit of an aggressive stop loss placement, where the stop loss wasn't really placed at the exact high, which was this bull candle with that spike, but nevertheless it was still comfortably above the counter trend line itself and above the downtrend line. And as you can see here, the market, after entry took place, the market actually reversed temporarily and actually threatened the position. But because the stop loss was placed comfortably above the downtrend line and the counter trend line, this stop loss was never going to be in danger of being hit. And as you can see here, the market U-turned and eventually hit the trading target in response to the overall momentum, the bearish momentum in favor of the Japanese yen. So you'll have these types of temporary pullbacks along the way after you have entered the market. But as long as the trend direction is accurately identified and you have placed your stop loss at an area that is far enough and at a strong enough area, then these temporary reversals will not affect your trade, and you'll be able to still be in the trade until the market eventually hits your trading target. Now, in terms of the right time and signal to trade and exactly when you should exit your trades. Now, because I trade on the daily chart and the 4-hour chart, which I highly recommend persons to do, you have predictable times when the market is going to provide us with these signals. So if we're waiting on a signal on a 4-hour chart, we know exactly when to check the market for these signals. And if we're waiting on a signal on a daily chart, then we know exactly when the market is also going to be providing us with that signal. So all of these candles, 4-hour chart and the daily chart, close at Eastern Standard Time at these times: 1 a.m., 5 a.m., 9 a.m., 1 p.m., 5 p.m., and 9 p.m. in the case of the 4-hour chart, and of course 5 p.m. Eastern Standard Time in the case of the daily chart. So in the case of the Euro Japanese yen, what was key for this trade was to wait until the daily chart provided me with a signal, and in this case this was at 5 p.m. Eastern Standard Time. So I know exactly when to check for a trading signal, depending on what I'm looking for that particular currency pair. So in this case, I need a daily chart to provide me with a signal, so I know exactly when to wait for that signal, and then assess it, and then decide whether or not I'm going to trade it or not. And in my particular case, with my strategy, I actually have two trading approaches. One approach targets 50 to 70 pips within a 24-hour trading period, which provides me with the guideline in terms of when I should exit my trades. Because what you'll find is that if you have set a trading target of, say, 70 pips, 50 pips, 100 pips, or 200 pips, you have to determine how long you're going to wait, the maximum waiting time that you're going to have for that particular trade, for that particular target, before you exit the trade. Because you don't want to be in the trade longer than the market is actually going to be supporting your trade. So there are times when the market will give you a particular range of movement within that time period, but for some reason it will not hit the specific target that you have in mind, and it will start to reverse after that holding period has ended. So you want to establish that holding period for that particular trade, so that you're not holding trades beyond what the market is going to be offering you and providing for you at that particular point in time, because you don't want the market to reverse and take away your trading gains. So in my particular case, with this first strategy, the maximum holding period is 24 hours. So if I set a trading target of 70 pips and the market has only reached 50 pips or even 40 pips, I exit that trade regardless of the fact that it has not actually hit my original trading target. Because usually if the market has not hit that target within that time frame, it usually means that the market is not going to hit that target. So it is better to establish that maximum holding period and stick to it to avoid market reversals that can affect our trading profitability. Now, in the case of the second approach, which actually involves trading to a maximum of 100 pips within 2 days, which was the case for the Euro Japanese yen, this trade actually hit the 100 pip target well within that 2-day limit, hitting the trading target in just over 18 hours, as you can see from this graph. So there are times when the market will hit our targets within your established holding period. In this case, for me, it is 2 days, and in some cases 24 hours. But again, you want to establish that holding period and stick to it, because of the possibility that the market can reverse and not hit your trading target beyond that holding period. So these are the approaches that I believe one should take, and if that approach is taken every time we assess the currency market, then you can establish a consistent level of profitability over both the short term as well as over the long term. So as you can see here, this latest trade on the Euro Japanese yen provided 100 pips and is actually part of a series of consistent profitability so far, using this approach. Last 8 trades, most of them have been profitable, as you can see here, with only one real trading loss coming on the Euro Aussie dollar. The other trading loss technically was a loss, but it was actually a quick change of mind on my part in terms of whether or not to trade this. I decided at the last minute that it wasn't worth the risk, and so I exited the trade shortly after entering the market. But nevertheless, the overall picture is that this is a consistent rate of profitability that can be achieved once you accurately identify what is taking place in the market and follow certain rules that allow us to profit from it. So these are the 8 main ways, the 8 main steps that should be taken to accurately identify what is taking place in the currency market so that we can achieve consistent profitability by entering at the right time and choosing our stop loss areas and identifying where the market is going to be headed, choosing our trading targets correctly, and exiting within the holding period established for our trading strategy. Once all 8 steps are consistently used, then you put yourself in a much better position to achieve consistent profitability over both the short term as well as over the long term.